Welcome to the vault, where the noise stops and the real money conversation begins. This is not hype. This is not headlines. This is macros, metals, and markets. Let's get into it. China's sudden strict enforcement of refined silver export restrictions on January 1st, 2026, has effectively removed 350 to 400 million ounces of annual supply from Western markets, creating an immediate structural shortfall, contract cancellations, and a violent divergence between physical and paper silver prices. For 2 decades, much of the world's mined silver ore has been shipped to China for refining, giving China control over 60 to 70% of global refining capacity and a dominant position in supplying refined silver to Western industry and investors. The export regime makes Chinese refined silver functionally unavailable to the West. China's new rules require refiners to produce at least 80 metric tons annually, hold 30 million plus in credit lines, and obtain shipment by shipment government approvals, leading to 28 of 30 contacted refiners denying export capability, and the remaining 2 refusing new orders pending clarification, effectively a 100% shutdown of Western-directed flows. The lost Chinese supply cannot be fully or quickly replaced, creating a hard deficit. Western buyers are losing 350 to 400 million ounces per year, while realistically accessible replacement sources uncontracted mine output, COMEX registered stocks, limited free London inventory, and diminished dealer holdings total only about 280 to 330 million ounces, implying a structural annual shortfall of at least 70 to 120 million ounces that hits immediately rather than gradually. Physical silver is already repricing far above frozen paper benchmarks. While COMEX closed at $77.20 before the ban took effect, major U.S. dealers have raised physical prices into the $115 to $128 range, 50 to 65% above paper, anticipating higher replacement costs and using real supply constraints rather than futures quotes to set prices. As industrial users scramble after canceled Chinese contracts and long lead times from alternative refiners, a sharp gap up in COMEX prices when markets reopen is expected, with a likely move toward current physical levels, $110 to $130, as paper is forced to reflect physical scarcity. Holders of physical silver are framed as being vindicated, while those relying on paper exposure may face rapid, violent repricing in a market where new refining capacity and mine output cannot be brought online quickly. This is a quantified view of a sudden, policy-driven silver supply shock that is already reshaping real-world pricing before paper markets react.